So I got a lot of stuff. There was also because the moment the trip starts, I mean, they have like a 9 a.m. They take already like there's just no time to it's just only and after the else, Ryan? So you said you were thinking also after 6 years. So you left it's they don't, you have to go back to the we should probably talk about that, right?
All right. 1, 2, 1, 2. All right. So good afternoon, CSIMA members, and thank you for joining us. It is my honor to introduce our distinguished speaker today, Mr. Robert Hagstrom, a Chief Investment Officer of EquityCompass and Senior Portfolio Manager of the Global Leaders Portfolio. With over 30 years of investment experience, Robert's career highlights something went wrong here, but including being the Chief Investment Strategist at Legg Mason Investment Counsel. He's the accomplished author of 7 investment books, notably The Warren Buffett Way, a New York Times bestseller translated into 17 languages. Robert is a CFA. He earned his bachelor's and master's degrees from Villanova University, showcasing his commitment to excellence. Please join me in extending a warm Columbia welcome to Mr. Robert Hagstrom.
Thanks very much, Tom, and good afternoon, everyone. Thank you very much for the invitation to come to Columbia. This is my first talk at Columbia, so I get to check that box. I got that one. I always enjoy these. I graduated from Villanova, and I live in Villanova, and so I do this quite a lot at Villanova. But I really enjoy this time with students, and particularly grad school classes. And I assure you, we're going to spend about 75% of the time with your questions. I'm going to, up front, kind of give you a couple of things that went through my mind about how I got here and how it worked and things of that nature. But I really want to just riff with you because I think we'll come away a lot smarter to the degree that we're able to have a conversation. So I'm really counting on you to participate. It's amazing. The Warren Buffett Way is now 30 years old this year. It just, you talk about 3 decades that went by very fast. It's going to come out, Wiley is going to publish the 30th anniversary edition. This time, though, is a Wiley Investment Classic, which that was my key. That I said, okay, I'll do it if you do that. Because the list of books that are in the Wiley Investment Classics is pretty impressive, and I think Warren will get a kick out of that as well. How many of you read the Berkshire Annual Report over the weekend? A very touching piece with Charlie. You couldn't have said it better, and it's absolutely true up and down. I like the way he said, Charlie, helped me understand the right way to do it, and then I just began to allocate the way that Charlie told me how to allocate it. But, it really did bring kind of a tear to our eyes. We really had hoped that he'd make the 100, and then we certainly wanted to see him again in May. But he'll be missed, but we're having a big Charlie Munger tribute on Thursday afternoon, where I'm going to talk about Investing the Last Little Art, which was a book that I wrote to try to take up Charlie's challenge about how to do multidiscipline thinking. But I thought I'd give you, 10 minutes up front as to maybe how I got to this point, and it really was random that I even got here. I was a liberal arts major in college in Villanova, did my undergraduate and graduate in liberal arts, political science. I wanted to go to Washington, D.C. and be the next Woodward Bernstein kind of guys, and got to Washington and realized what a terrible place this is, and had no appetite to stick around. I had done some writing in college for the Villanova paper. I started the Libertarian Society, and it was kind of a young crisis that I had. It was fun, and I wrote for a paper called the Suburban Wayne Times, and I interviewed congressmen and senators, particularly around election time, and their views on policy and things of that nature. So I went back to the paper and I said, I'd really like to have a job. I could be a reporter for you. And they said, well, we can't pay you. And I said, well, that's not going to work out. And they said, well, I tell you, if you'll sell quarter-page ads in our newspaper, once you have sold so many ads, we'll talk about cutting you a check. And I said, okay. So in Villanova, out in Philadelphia to the west of Route 30, that's called the Main Line. It's just one big long shopping center, if you will. And I would just walk up and down the street knocking on doors saying, I'm Robert Hagstrom, would you like to buy an in our newspaper? And just, small shops, art shops, whatever, it didn't matter. And I came across something called Legg Mason Woodwalker Members of the New York Stock Exchange. I had no idea what that was. I thought it was a law firm or an accounting firm, and I was like, should I, let's just go, back and forth. And I finally walked in and said, good to see the manager, what's this about? They took me back and I said, hey, I'm Robert Hagstrom, would you like to buy a quarter-page ad in the newspaper? And this was 1984. And he looked up to me and he said, no, would you like to be a stockbroker? And I said, well, I hadn't thought about that. And then the bull market had just started in 1982 and they needed brokers. And brokers sell, and that's what I was doing, selling. So I went into training, 3 weeks of training at Legg Mason down on Redwood Street in Baltimore. Our whole Michael is here with me, and I appreciate him being here because when you ask a question that I can't answer, I'm going to point at him and he will answer it for me. Went into training and I thought I had made a terrible mistake. It was the Thursday of the third week. Our last day was Friday and I was going to resign. I thought, I was totally clueless. I didn't have any accounting, finance, economics, or anything. And, I thought this was a terrible mistake. I was embarrassed. I wasted their time. And that Thursday night, they gave us a copy of the 1984 annual report and said, read it and come back the next day and be prepared to discuss. So I took it back to the hotel room and opened up the annual report and was instantly depressed because if you ever, you read Berkshire Hathaway, there's no pictures, there's no graph, it's just 20 pages of Warren lecturing to you. And I got started with it, and it was the proverbial light bulb goes on. It wasn't one of those epiphanic moments of your life where you went, oh, I finally get it. We're talking about companies here. We're talking about people and products. And, you talked about Rose Blumpkin, who started Nebraska Furniture Mart, and Chuck Huggins at See's Candies, and, all the guys up at Buffalo News, and, we had Jack Byrne and Geico. And so Warren spent the whole report talking about these companies. And when I was in training, all I saw was numbers. And we did a value line investment survey, and it's just numbers, and it just wasn't computing. But when Warren said, okay, I get it, this is the way I do it, I went into production, and all I did was, I was like a kid following a ball player. I got every annual report back to 66. In those days, you sent a check for $25, they send it back to you before the internet. Had all the annual reports of the companies that he bought, and I just read any article, anything, I just, was collecting. And went into production, and my manager came up to me one day and he said, you could actually double your salary if you ever sell anything. I said, well, that's not the way this works. We're trying to compound the value of these things over time. But in those days, it wasn't fee-based. It was before E.F. Hutton took off with that. And so I went to the buy side, got to a little investment counseling firm, got my CFA, and in 1992, the CFA Institute came out with the Performance Presentation Standards, which said if your investment advice is not 100% discretionary, you can't publish that as your performance. And we were kind of like a trust company. And if you had a favorite stock, or there was a tax issue, or gosh, my son really likes this stock, so it was kind of a hodgepodge of things which would not have qualified as discretionary track record. And I told my partners, we're in a lot of trouble. I said, we don't have a track record anymore. How are we going to get clients? And they said, what's your proposal? I said, we've got to get a track record, discretionary. And they said, what do you want to do? I said, let's do this Buffett thing. And they said, Robert, I'm up to here with you and Warren Buffett. That's all you talk about nonstop. And they said, okay, write a white paper, something, a marketing piece on it about what you want to do. And we'll see about that. And I did, and it got grabbed by somebody who was in the book business who said, Robert, this could be a really interesting book. And I said, I don't know anything about writing a book. And I went to the Sampson Street How to Do It bookstore in Philadelphia. It's one of these bookstores on Sampson Street. It was like how to fix your car, how to put a roof on and gutters, and one of them said how to write a nonfiction book. Now I want to distinguish what I'm talking about. A nonfiction book is different than a fiction book. I cannot write fiction whatsoever. I have no time. I tried it a couple of times. It was so horrible. I burned it, I shredded it, I said no one will ever see it. But a fiction book said, how do you write your first nonfiction book? They asked the question, have you ever written a 20-page term paper? I said, yeah. Have you ever gotten a B or better? I think about it, but I said, yeah, there's got to be a couple of B's in there. And they said, could you do 8 over a year? I said, crap, I used to do 3 in the last month of the semester. I surely could get 8 done in a year. And that's a nonfiction book. And so I actually wrote in, talked about a proposal. So the whole Warren Buffett Way book, if you think about it, was really nothing but a term paper. There were 8 term papers in there. And when I sit down to this day and write a book, I never think about writing a 250, 350-page book. I just think about writing a string of term papers. So I share that story with you because there's a book in every one of you. And so if you ever have a thought about writing a book, think about your experiences here. And it could be quite rewarding, as Michael and I were talking about it. Once you write it down, you become an authority on it. You own it. And you're very good at it. But writing does. It's kind of a lost art now. But when you write something down for 20 pages, much less 250 pages, you get very good at it. So don't let that dissuade you from ever writing your first book. I don't know. So what do we want to talk about, Tom? We're going to talk about liberal arts investing. I want to talk about something that I'll riff on, and I'm going to keep an eye on my time. So Charlie said in the 1997 annual meeting, quote, he said, the Berkshire style of investing is so simple, he said, but it's not widely copied. I do not know why. It's not the standard in investment management, even at great universities and other intellectual institutions. It's a very interesting question. If we're so right, why are so many intimate places so wrong? So the trick is that, Michael will correct me, largely what you're taught at the undergraduate level, maybe even at the graduate level, is kind of standard portfolio theory, standard investment management, with its roots dating back to, B. Harry Markowitz in 1952, right? It's interesting, and the book that it would be, one would be Capital Ideas, Peter Bernstein's book that talks extensively about the history of how modern portfolio theory came to life. And it's interesting if Harry Markowitz, liberal arts major, played the violin, his favorite philosopher was David Hume, a Scottish philosopher. And he decided to go to graduate school at University of Chicago and was going to do economics, and ran into a gentleman at the dissertation, his professor's dissertation meeting, who said, man, you should do a report on the, dissertation on the stock market or stocks or something like that. Got intrigued. And lo and behold, basically, what he then delivered in March of 1952 was called Portfolio Selection. And that was his dissertation. That was the basis of his dissertation paper. It was 14 pages long. By any standards of academic journals, it was very unremarkable. Only had 4 pages of text. The rest were graphs and equations. He cited 3 people: John Burr Williams' Theory of Investment Value, John Richard Hicks' Value in Capital, and James Uspensky's Introduction to Mathematical Probability. It was a very simple concept. He just said, I think risk and return is something we ought to think about. Makes sense to me. And he illustrated it by the infamous graph, the efficient frontier, risk on this way, return that way, draw a line. For every unit of risk, it's a unit of return. I'm okay with that so far, no problem, right? And then we get into his paper. And he writes, basically, he says in the first paragraph of the paper, we consider the rule that the investor does or should consider expected return a desirable thing. I get that. Returns are good. And the variance of a return, an undesirable thing. Well, okay, he thinks that if stock prices bounce, that's undesirable. Well, let's keep going. Markowitz notes the terms yield and risk frequently appear in financial writings but are not always used with precision. He suggested if the term yield was replaced with expected yield or expected return, okay, and risk by the variance of the return, little change of apparent meanings would result. Okay, this kid is 22 years old. He has now defined risk as bounciness. I said to myself, that's kind of a gigantic leap for any 22-year-old to now define risk as bounciness. I would say that was somewhat pretentious of someone to do that. And in fact, there was no explanation of economic risk, like loss of permanent capital. Let's go back, 1952. What had already happened in 1952? Security analysis was in its third edition. He had Ben Graham there telling him, no, it's not bounciness, it's margin of safety. It's not if you're buying something at a big discount to what it's worth, you're operating with low risk. If you're buying something above its value, you're operating with high risk. Ben never said that bounciness was risk. In 1949, he published The Intelligent Investor. Same type of preaching was still going on. And then it dawned on me. He had a dissertation committee. He had a PhD advisor. He then quoted John Burr Williams as his citation, and if you go back to John Burr Williams in the preface, John Burr Williams wrote, investment value defined as present worth of future dividends or future coupons and principal is of practical importance to every investor because it's critical value above which you cannot go in buying and holding without added risk. He basically took a nod to Ben Graham, right? John Burr Williams agrees with Ben Graham. Risk is paying more for something than it's worth. Didn't say anything about volatility. Markowitz cites him. But not anywhere in his dissertation does he make mention of Ben Graham, security analysis, intelligent investor, or even the guy that he cited. That was the first book he read, was The Theory of Investment Value. And to this day, I want to go back and go to the dissertation committee. Isn't it your responsibility to basically make sure that when you have a PhD student, make these assumptions brand new, never written before? You should look at the counterfactuals. Like, who else said something different? And what was it about them? And they let it slide. Now, the question is, where were the props? I heard one, conspiracy theories, I don't know if it has anything, but what was the most prominent business school in the country in 1952? You're sitting in it. Ben Graham owned it. David Dodd owned it. This is where people came to learn investing. University of Chicago was an up-and-comer. They were trying to make a mark. Is it possible that they were taking a different tack and trying to think about how to manage money, that it's not margin of safety, it's bounciness? I don't know if that's true or not, but it's interesting to think about. Okay, so then what happens next? 1963, Bill Sharp is at UCLA. He's in need of a thesis idea. Professor says, the guy Markowitz in Chicago, he's a pretty interesting guy. You ought to go talk to him. And Bill Sharp's claim to fame was basically, instead of doing all these, because he was working on the bounciness of stocks and things like that, but he had to do it individually, and it was really quite mathematically complex. And it was Sharp that came up with the beta and said, let's just chart each stock relative to something, and the market being the most important impact on the stock, and there's beta. Okay, 1963. So where was Warren Buffett in 1952 when Markowitz did his paper? Well, he just finished his first year at Columbia. And he had sat at Ben Graham's class and learned everything about it, headed back to Omaha, and started to invest. Where was he in 1963? He was in the 7th year of the Buffett partnership, posting astronomical numbers based upon the margin of safety. And what is interesting about modern portfolio theory is that even after Markowitz wrote his paper, Sharp wrote his paper, we could even go to Eugene Fama, nobody cared. Nobody cared. Wall Street didn't pay any attention whatsoever until 1974. What happened in 1974? That was the end of the 2-year bear market. We cut money in half by 50%. People were furious, and this is in Peter Bernstein's book, talks about it extensively. Pensioners were like, I can't, I'm not going to be able to retire. People were going ballistic. Now, the question is, what happened to Columbia? We're the bastion of margin of safety, how to think about this thing rationally. A guy named Roger Murray took over for Ben Graham in what did I say, Mike, when I wrote that down? Ben Graham retired in 56. Roger Murray took over his spring course that Buffett took, right? Then David Dodd retired in 61. Roger Murray then taught the fall class and the spring class. Everything's working fine. But then Murray retires in 1977. Okay. And at that point, the value investing program at Columbia was ended. There was no more talk of security analysis. There was no talk of margin of safety. And in 74, people were losing their minds as to what was going on in the market. Peter Bernstein, though, who had a great wealth management business, billions of dollars, like 12, it was a huge practice, started the Journal of Portfolio Management. And what he did in starting the Journal of Portfolio Management, he got overwhelmed from papers coming in from what I call these high priests of modern finance coming out of Chicago going, we told you so. We told you this price bounciness is bad. Bernstein said, I didn't really get it, but there was so much of it coming that I couldn't ignore it. And my job was to try to build a bridge between the gown and the town, the gown being academia and the town being New York City. And it flooded. Not too far removed from that, Mike would help me remember, prospect theory came 77. So then we had Tversky and Kahneman saying, 1 unit of pain is twice as uncomfortable as 1 unit of pleasure, and the academics probably jumped on that as well, even though we're very deep in academia. And all of a sudden, in that vacuum, Ben had left, Roger Murray had retired, there was no value investing going on in Columbia. We blew up the stock market. And these guys out of Chicago who had never managed money, never owned a business, probably wouldn't even know what the New York Stock Exchange looked like, had defined risk as price volatility and said, our job is to make that demon go away. The demon is bounciness. So we'll put together portfolios with negative correlations, and we'll make it nice and smooth, so you gotta buy a little bit of this, a little bit of that, just as long as it doesn't behave like the total. And that is what became standard portfolio management today. Risk tolerance questions were adapted for clients to sign. Today at Stifel, out of our 10 questions on risk tolerance, 6 of them ask you, how do you feel about bounciness? I don't know anybody that says, I love it, other than Charlie Munger and Warren, who says, that's my bread and butter. I love bounciness, right? That's what I live off of. Those are my excess returns. So what Charlie says, how did we get this disconnect? That's how it happened. The question that I can't answer, and I want, we're going to spend the rest of the time with you, is how do we get back to making this more of a mainstream instead of an accent? If you think about the amount of money that is managed under the Berkshire model, there's some smart people, but as a percent of the total money managed in equity today, what do you think, Mike? Less than 5%? Yeah, nothing. Here's a guy, one of the smartest guys that ever managed money, considered to be the world's greatest investor, track record there, the most transparent, this is how we do it. People have written books and books about him and everything, and the industry doesn't care. And the industry is like freaking out because where's all the money going? Because standard practice of portfolio management is not doing that great of a job of outperforming the market. Where's the money going? Well, the first headed the indexes, right? People got pissed off paying a lot of money for active management that didn't outperform. So let's give it to that's Jack Bogle's bread and butter. Then where did it go? Alternatives. You got to give David Swenson credit. He was there early and he generated huge excess returns. Now, everybody and his mother is in alternatives, from venture capital, private equity, and all of that. Interesting note is that you know that the average private equity return historically, Michael will correct me, I think it's just the S&P 500 levered 50%, which is basically what they do with their private equity. They take private equity and they leverage it 50%. So they just played a different game, and they got a lot of fees for it. So what happened to us? What happened to the crew? I don't know. It's a great strategy. It makes a lot of money. You know, Michael wrote about early. I wrote the Warren Buffett portfolio in 1989. Michael was with us at Legg Mason Capital Management. No, that was right after you came right after that. We wrote Focus Investing, and we did a very simple thing. We just looked at great focus investors. So Buffett, who was the only guy in the Buffett partnership that never had a negative year, had variance less than the market. We looked at Charlie Munger, John Maynard Keynes, the very first focus investor. We looked at Lou Simpson. We looked at Bill Ruane and Sequoia Fund. Every single one of them, batting average was about 30 to 40%. I should say that. The batting average was about 50 to 60% beating the market, 30 to 40% underperforming the market. Drawdowns, yeah, they happen, but they all had phenomenal long-term track records. My own experience is that, I sent you the numbers, we've outperformed since inception, numbers are good. Our batting average is 50%, which means monthly, quarterly, yearly almost, we're underperforming on a price basis 50% of the time. How do you beat the market? You're underperforming 50% of the time. And the answer is the difference between frequency and magnitude. It's not how many times you beat the market, less how many times you get back. It's how much money you make when you beat the market, less how much money you get back when you don't. And if you're a value investor, particularly a value investor in growth stocks, Bill Miller being one, when it's like slugging percentage. When you win big. Think about Warren and Apple. That's slugging percentage, right? It's not frequency. Even Warren says, you know, hadn't been my 8, 9, 10 best picks. My track record would have been nothing more than average. But Mr. and Mrs. Smith can't get on board. We can't get them on board. They still equate it today. If it's going down in price, it must be bad. If it's going up in price, it must be good. If your performance is underperforming, you must be a bad manager. If your performance is up, which Michael has written extensively, has nothing to do with that. He's cited several studies that show that there's nothing to that as a predictive value. Robert Rubin, right, you know, talked about that. We talked, you know, process and outcome. We know all that. But we can't get them on board. And I think it's a shame because I think this is a low cost, very conservative, margin of safety, by good companies at a discount. And as Lou Simpson said, I put this up on my wall all the time, identifying and buying great companies is not difficult. They're staring at you all the time. Get them at a fair price. You don't have to get them in a wholesale. I mean, if the market sells off like it did in 2022, I mean, it was galore. You just were swimming in it. Great companies, you know what they are. You know the attributes. You know what attributes of great companies are, right? You buy them at a fair price. You don't have to buy it at a big discount. You buy it at a fair price. He said, that's not hard. And it's not. Every one of you can do it. He said, the hard thing is holding on to it. And there it is. Because holding on even to a great company is going to have periods where it underperforms the market. And then that's where we got the client. The client says, you're underperforming the market, you must be stupid. Right? It's only when you're out there. But when we talk about Kremers and Pettigewstone, high active share investing, it's right there. You know, high active share is a predictor of performance, but it is high active share, low turnover, patient investing, right, that can get it done. And that's a frequency versus kind of magnitude type question. So I got that off my chest. I feel better. I had to come to Columbia and give you that bit of information. I believe that, you know, Chicago understands the price of everything and the value of nothing. And I believe Columbia understands the value of everything. We just got to figure out how to deal with this demon called price. So let's stop there, Tom, and we'll open it up for the rest of the time with everybody else.
Yeah, of course. I will. First of all, thank you for these words, and yeah, we are very happy that you think that way about Columbia Business School, and some of us here are in the value investing program, and the others, many of them probably want to apply for the program. So maybe the first question, I will start with the first question and then we'll take it on to you. I read a bunch of your books and I fear that some of the students here didn't. So I want you to recommend one book, just one, pick one for the students, which is a must read. It doesn't have to be your book, by the way, but just one.
Well, I'm not saying this because of Michael, but, you know, there's nothing that Michael doesn't write. A Christmas card, I say that, you know, whatever. I know the Modrian across the street, you know, he's his own rock star and everything, but I think Michael does. I'm just telling you, I've worked with him, and he's doing probably what I think is the cutting edge, leading edge work. So anything that Mike was writing, I thought Expectations Investing was great. And I thought it was a tremendous book. He had a great mentor, Al, tremendous guy, how to think about economics. That would be, you know, anything that Michael writes is top on my list. But it's interesting, there's so much out there that you'll do well reading. One of the things that I learned from Bill Miller, and Michael did too, was it's not the bell curve that what we're all reading. I mean, because you get a bell curve, there's a lot of really good stuff, and there are a few things on either tail not worth your time, and some good things that are classics over time. But what I learned from Bill, and what we learned from Bill, is what were the great insights from books that you would never thought you should be reading, and you know, in philosophy, and science, and Michael being former chairman of the board of trustees at the Santa Fe Institute. Let me tell you what, and correct me if I'm wrong, Bill Miller's track record in the late 1990s was largely built on the insights at Santa Fe Institute, not from a CFA designation or the Financial Analyst Journal. When he began to understand network economics and feedback loops and all that was going on, because they were studying, you know, these complex adaptive systems. When he had, you know, America Online, he had Dell didn't quite work the network model, but AOL did. You go to Amazon, you go to Google, all the way up. That's Santa Fe. That wasn't, you know, not disparaging Columbia. It's now being taught at Columbia because of Michael, but it wasn't being taught at that time. Bill's work in philosophy, you know, he was a PhD, you know, he did military intelligence, and I kept peppering him about that stuff. He won't really open up too much about it, but there's good stuff there. He was a baseball pitcher. I studied baseball pitchers. Interesting baseball pitchers, how they handle pressure, how they handle getting hit. That's a loss. You got to pitch again to get a strikeout. You know, that game, that mental game of baseball is very interesting to me. Intelligence, I've read a lot of it. One of our favorite books in book club was The Theory of Intelligence Analysis. Is that the theory? Psychology of intelligence analysis. That's good stuff, but it would be the philosophical work. Bill basically wanted to be, his last year at Washington Legg, he had to take one more course to graduate, and he took over a summer a philosophical course. And his teacher actually happened to be, I think it was an Air Force pilot or something. He told me the story. He was in the Air Force, and he would take Bill up on the plane. He was a fighter jet pilot, and started getting interested in philosophy. So Bill went back into military intelligence and did a tour in Europe, and basically wanted to go to get his PhD in philosophy. He sent an application to Cambridge, which he summarily found out that when he put his application in the mail at the Army Depot, it never reached Cambridge. They found it like 6 months later behind the cabinet, so that application never made it. He sent it to Yale, was not accepted, and he sent it to Johns Hopkins, which had a policy that out of 20 some odd PhD guys or people that were coming in, 1 or 2 slots were actually left open for someone who didn't have a philosophy background. But Bill was charged with writing a paper, and he had read enough about philosophy at the time. I would say his tour of being a philosopher at Johns Hopkins and his work at Santa Fe Institute, maybe more than 50% of his excess returns were there. So when you think about that, when you ask me what great investment books, we know them. You know, You've got to do the checklist. It's what he learned on top of that other people didn't learn that gave him that extra view. So, what did he learn? William James was his hero, the philosophy of pragmatism. How he went from Ernie Keeney, who started the Value Trust, Ben Graham centric. They were Ben Graham 101, right, when they started the Value Trust in '82. Then Bill started reading Buffett, and he took his half of the Value Trust. Ernie held on to the low PE stuff, and he went to Buffett, right? He started buying, good businesses. And then this tech thing happened, and he was at Santa Fe, and he moved the portfolio there. He just kept moving. Pragmatism is not so much a philosophy, it's a way of doing philosophy, which is that which is working. That which is working, you figure, why is it working? And if it's working, it might be something good. Go figure it out. How many people, value investors, turn their nose up at tech for a decade plus because it wasn't a low peak stock? And Bill just, he said, William James just moved me right through it. If you study pragmatism, you're right through it. Wittgenstein, Wittgenstein, Bertrand Russell said probably the greatest example of genius he'd ever met. And Bertrand Russell was a pretty good genius too, so if he was that good, he did the philosophy of logic, mathematics, but philosophy of language. And his books, he said, it's all about the words that you choose. The words that you choose form a description. The description that you have is then ultimately your explanation. And that was Benoit Mondor brought out at Santa Fe one day when we were having a big argument out there. Who quoted Wittgenstein? They were all arguing back and forth. And he said, failure to explain is caused by failure to describe. You get the wrong description, you get the wrong explanation. How many times do you see that in investing? When we bought Amazon went public, what was that, 98? 97, thank you. And Bill went to meet Jeff, and he relayed the story, walking through the model. And he said to Jeff, what's your business model? And he says, it's Dell. Bill went, what? Because Bill had owned Dell Computer. He bought it at 6 times earnings and went to 41 times earnings. Bill held it because it was the very first company ever to generate negative working capital. It was the very first company ever to generate 100% return on capital. Because basically, Michael Dell, you read it in his biography, he could bring in the inputs, the keyboards, the monitors, whatever, the components and everything like that. He would get it in his dorm room, wouldn't have to pay for it for 90 days. And he would sell the Dell computer on the 1-800 number and get your credit card that night. He built the whole business on accounts receivable, right? So that's how Dell was being grown. And that's basically what Jeff Bezos did with Amazon. What was everybody else telling you about Amazon at the time? It's Barnes & Noble. That was their description, therefore the explanation of how the company would operate. They said, well, Barnes & Noble is much cheaper than Amazon is. You should get long Barnes & Noble and short Amazon. That didn't work out. They said, well, no, it's not Barnes & Noble. Really, it's Walmart. Because they're doing videos and they're starting to clothes and stuff like that. You should get long Walmart and short Amazon. Well, that didn't work out. Jeff Bezos did the same thing. With books, you could basically keep the books and return them and you never have to pay for them. He had no inventory cost. So once again, Wall Street had a description of what they thought was a company, and the explanation was wrong. Bill had a different description, and his explanation was right. Today, he still has $9 Amazon. It's his second largest holding after Bitcoin. So those insights, okay, you only need a couple of those in your career, and that's all you need. So, I'm not trying to push a book, but Charlie Munger was right. Multidiscipline thinking is a huge advantage because most of the people that you're going to compete with don't think in multidiscipline terms. If you do, you got a leg up on them. What else?
I guess, what do you think, investor operating the Buffett tradition, what are the biggest mistakes they tend to make? Do you think it's over diversification or not learning the new business models?
Buffett would say that most of his mistakes were not mistakes of commission, although you could argue that airlines were a mistake. IBM was a mistake, but I don't know. I have to go back and look at IBM. That was a huge bet. It was a $10 billion bet. That was the biggest bet he made. And it was a technology bet, right? But he would say it was the bets of omission, right? What was laying in my lap that I didn't take advantage of? And he said at the meeting, it wasn't that long ago, he said, Amazon was staring me in the face. I actually bought things on Amazon, right? I I bought books and things like that. And he actually owned the Amazon bonds, but he could never get the Amazon. Just think if he got that Amazon stock even 10 or 15 years ago and bought it in size, like 10 billion of IBM. And, you know, Charlie said the same thing about Google. Said, you know, we kept looking at the Geico expense statement and he said, we kept sending millions and millions of dollars to this company called Google. And Charlie said, what the hell is Google? They said, what's this search engine? Well, what the hell is that? And they said, well, every time somebody searches for automobile insurance and the Geico website pops up and they click it, we got to send a nickel. And Charlie goes, well, you're sending a hell of a lot of nickels to Google. Yeah. And they just let it go by. And they said at the meeting, and this is where pragmatism comes back, he said that, you know, both Warren and Charlie had been raised and read and experienced working with Rockefeller, Carnegie, Ford, the brick and mortar world. They had no idea that you could build these hundreds of billions, now trillions of billions of market cap with so little capital. They were still brick and mortar guys. So those were the mistakes. But, and then Charlie said at the same meeting, he said, well, perhaps Apple's our atonement, you know, and that's probably right. Though Apple was not Warren's stock at the beginning. It was probably Ted. I think it was Ted Wexler. I don't think it was Todd. I could be wrong. But Ted had it. But then I think Warren looked at it and went, oh. And then he saw his grandkids with it and other people with the phone. And then the problem is, even when Warren bought it, you can reverse engineer Apple. The market was paying for no future growth. Now here's another failure to describe, right? When Warren bought Apple, what did they say? Why are you buying Motorola? Why are you buying Nokia? No, he wasn't buying that. He was buying Louis Vuitton. There was a reason why the Apple store at Champs Elysees in Paris is next door to the Apple store, like on Fifth Avenue. It is the Louis Vuitton phones. The margins on those things are killer. And then Santa Fe brings you back to network effects. Once you get a hold of an Apple and you learn how to operate it, lock in, path dependence, feedback loops, you're not going to an Android. There's just no chance. And I think when Warren flipped that, he said, okay, it's not going anywhere. And then I think Ted said it's the App Store. The App Store was probably 10% of the business back then. It's now 25%. But that thing's growing like a weed with 70% margin, probably even higher margin business with over 100% return on capital. And then when the market figured that out, that's when it geared. So it's the omissions more so than the commissions. We all are going to make mistakes. I make mistakes. You know, we all make mistakes. It's things that you should have got that were right in front of you that make me nervous. Yeah.
Can you talk about like what opportunities you see out there that are like, and not in terms of just like investments, but like areas for us as future investment managers to take advantage of?
A good question. Well, you go where the money is, right? You got to figure out where the money is, and then figure out, can I do something better with it than what is currently being done with it, right? I think there's just too much shitload of money in private equity. I think it's $1 trillion of dry powder.
I just can't hear you from Mike.
Oh, I'm sorry. I think you go where the money. If I find out where the money, I'm less of a prospector trying to find a gold rush than I am. I'll probably embarrass myself when I say I think there is a gold rush in front of us. I can't dream up anything new. It's like, where's the big money pot now, and can I do something better with it than is currently being done with it? I think private equity has run its course. There's $1 trillion+ in cash they can't get invested. The returns, as Michael would point out to you, eventually the competition gets you returns. The returns are just not that great, guys, And people are beginning to wonder, I'm paying you all these fees. You got cash. You won't give it back. Private equity's got a little stink on it right now. So then the question is, why can't public securities play the private equity role? I mean, private equity role's got it going, coming, and going. They don't have to report price. Their NAV never changes. Their NAV is $1, and next year it's $1.05, and then the next year it's $1.07, and it's a little recession, so it's $1.03, and then at the end of year 7, it's like $2. Well, Kahneman and Tversky go, that's a nice ride. You never had a unit of pain. They game that system perfectly. But what do they report for their progress card? They don't have a price, so what do they report? sales, earnings, margins, name it, right? The economic returns of their business. Why can't you do that with public securities? I think if you could get on board getting to people, and it's going to be hard. We've been trying to do it for decades. To get them to say, get your portfolio of 10, 15 stocks that you think have a long competitive advantage period, that earn above the cost of capital, that have decent sales growth. Turn off the stock market. I'm going to report to you the returns just like the private equity guy. Measure me against your private equity guy. Let us play the same rules. Let us play the same game. And I'll charge you a quarter what they're doing. You could get a lot of money that way. In my mind, I don't think it's totally quixotic to do it. I think that's where our advantage to play this game resides. I think there's a ton of money. We can beat that money if you let us play the game by their rules.
Are you implying like a certain level of like involvement in your portfolio companies?
I don't think, well, obviously no, because we don't want turnarounds. We want great companies with good management. Their gig is, and it's not always the case, is their management's screwing up and we can do a better job of turning it around. Well, sometimes they can and sometimes they don't. Turnarounds are hard, guys. They're not easy. And so that's the selling sauce, right? I can turn this around. Let us go in there. We're going to fire everything. And in some cases it works, but in most of the cases it doesn't. But once again, I can get the average private equity return by the S&P levered at 50% and just write it out, and I can do it for nothing. So what's their game? So if you can say to a client, if a client said, I got a private equity portfolio, I'll say, okay, I'll compete against that for less fee. We get to play the same rules. He doesn't report price, he reports economics. I'm not reporting price, I'm reporting economics. Let's see who wins at the end of 10 years. That'd be fun to play, if you get somebody to play that game with you.
I'm curious, what's your view on 220 hedge funds?
On hedge funds? Well, there's some good ones. How do you not look at Renaissance and go, phenomenal, right? I haven't kept up with point 72. I don't know enough about it. What's amazing, David Einhorn had this speech at the Value Conference in London last year. It said value investing is dead. Pretty bold statement, but basically what he's saying is our numbers are few. The numbers have grown in not only alternatives, but in hedge funds. Now it's quant-driven hedge funds that are levered. I mean, the interesting thing about quant-driven hedge funds, Jeff Yoss is a friend of mine at Susquehanna. Our kids went to prep school together. I said, Jeff, what's the secret? He goes, volatility, Robert. I live on volatility. The more volatility, the happier I am, right? And I go, okay, I get it, right? There's your option value, and he does a lot of options and things like that. He's got, he has a trading floor, just like Ken Griffith at Citadel, all those guys. He's got a trading floor like a football field at Bala Kenwood, right? Andy Duke, right? And he says, see all those guys out there? There's only 3 of them I'll let hold money overnight. Everybody else is flat at 4. Damn, they can make money during the day. So they're banging those things around. That's not a game that I'm interested in playing. When a broker says to me, "Yeah, I'm gonna beat the market by speculating," I said, "You're better than Jim Simmons and those guys? Really? You're better than Ken Griffith? You're better than those guys?" Yeah, that's what it takes to win that game. A lot of guys don't have that. Yeah.
To follow up on your earlier comments on performance versus process,
Yeah.
if I give you like a pool of 20 investors, how would you kind of think about evaluating their, like who would you choose?
So there you have 20 investors or 20?
20 portfolio managers, I would say.
Yeah, it would be your long-term track record. And you basically say, how are you going to make money? So Charlie Montague says, all I need to know is a couple of things. Tell me what you own and why you own it. Ask anybody that. And if it's a stock guy or girl, what do you own and why do you own it? And there should be something that tells me that you have a variant perception in the market and you believe there's excess returns to be made. And the market doesn't get that. And then I go, okay, that's smart. I like that. Then we look at your track record and then, I wouldn't care about frequency negative. How did you do over 5 years? I think that's important. But it's all about what do you own and why do you own it? And Mike, what's your edge? What do you have? I think the edge that you have in this market today really is just the ability to hold something that earns above the cost of capital, has different sales growth through all the bumps up and down the road. You'd be surprised how much money you make to get there. Right? How many times did Apple go through, sell Apple because it's not going to sell enough Apple 7s? Well, then 8 came along and they sold a lot of 8s. It's just every time somebody wants you to sell something. it's just like, it's a good company. It'll power through. That's, you know, I'd like to see your willingness to hold things long-term and compound would be important to me.
So you talked about like modern portfolio theory, Fama, Markowitz, and you talked about value investing with Graham and, Warren Buffett. I guess, what are your thoughts on behavioral finance? I'm thinking like, Richard Taylor and like that type of investing.
Huge. I mean, if there's anything wrong with modern portfolio theory, Richard Taylor got a Nobel Prize and said, we're not rational profit maximizers. Can't be. Right now, as Mike points out, and so Wiki points out, we can have a lot of crazy people in there, and we can have a lot of smart people, a lot of crazy people, a lot of average people, and the wisdom of crowds get you a pretty efficient market, and that's basically true. And the inefficiencies come when we kind of lose the diversity and people go one side of the market. I would tell you, in my experience, the most money I've ever made has always been willing to be aggressive in down markets. I mean, the third quarter of 2022, my portfolio was down 39%. That's the biggest drawdown I've ever had, going back to 2008. I looked at it and I said, I'm close to 50 cents on the dollar, just doing easy dividend discount models and calming down the growth rates and normalizing the interest rates. I said, this is ridiculous. And you can see it, the quants were just ruling today. Anytime you go in and it's 9:30 and a fraction of a second, the screen turns instantly green or red, that's not me and you. That's not the value investors. That's not the trust companies. That's not a financial planner. Those are the robots. They go instantaneous. I said, Jeff, what is your biggest capital expense? He goes, I spend hundreds of millions of dollars on technology. I need a microwave in Chicago that can get me a signal to New York a microsecond ahead of Ken Griffin. I said, oh, that's when it goes all green, all red, right? They're gone. Now, the interesting thing is, what is the feedback loop for Mr. and Mrs. Smith? They're playing a game totally different from our game, but what does Mr. and Mrs. Smith think? The world's coming to an end. So, they're covering, they're short in the first few seconds off of the idiots that are selling it because they think there's something wrong with it. He goes, it's like picking up money off the field. All I have to do is just gang it, and they do it with lever. There's not that much liquidity. So they did it with the Russell 1000 growth because there's so much money in the market, they couldn't short individual stocks. So what did they do? They shorted the entire Russell 1000 growth. Every time the 10-year ticked up, you just short the Russell 1000 growth. It was perfect. Until you got to October of 2022 and NVIDIA was 160. I could never buy NVIDIA. I just couldn't get my hands on it. I knew AI was coming. I knew the GPU would be used in that. We knew that was coming. We didn't know it was coming this fast. But you just had to buy it at 160. And, Amazon was down 70%. All these things were just like, as Warren says, mass fear is your gift. Personal fear is your enemy. But when you have this mass fear in the market, I've made more money and I generated more returns for my clients being able to go balls in when it's down. Now, I called the brokers. I said, whatever you do, don't sell me. I said, if you can't buy me, I understand it. But whatever you do not sell this portfolio. And they said, Robert, they're pissed. Buffett this, Buffett that. They're down. They're pissed. I said, I know, but these things are cheap. You got to go with me on this. Don't give up the ship. And last year, we're up close to 40 and we got a lot of it back. We're up 10 already in 2 months now. So you get a lot of money during those dark periods. That's when you want to be aggressive. And that's where Buffett is aggressive. Think about 2008 and 9. That's when he had a shitload of money back then.
So the question is on evaluating decisions, looking backwards, especially for concentrated portfolios. So like, for example, you could argue that Amazon is probably, 2/3 is AWS now, right?
Yeah.
But every time, but at the time that the decision was made, it was probably, how do you evaluate that maybe you got it right, but for the wrong reasons? What do you do with that?
Well, what we did at Legg Mason Capital Management, we all had to keep a diary. I still keep a diary. So I write down why I'm buying it, why I'm selling it, and it loads up and you find out you made some bad decisions along the way. Typically, the bad decisions, Warren talks about this, is I just got the economics wrong. At the time, I didn't get the price wrong. I had the margin of safety. The competitive advantage period wasn't what I thought it was going to be. Occasionally, you get the management wrong, but not that often. if you've done your work on management, spent some time and investigated, it's usually the economics that you get wrong on the business. It didn't turn out the way that you thought it would. Amazon, I still think, is very, very interesting. Those of you who are spending time on AI, and Michael recommended a great book that I'm reading now called Prediction Machines. If you want a real easy book to get started, and it gets to the heart of the matter of what is the economic return of AI. I know you got a lot of work to do, but maybe take it over spring break. Great book. There's still so much room for cloud computing in this AI race. That, you can't do AI on a laptop. You can't do AI on a couple of frames now. In the old days, our company might have, a closet full of, big mainframes that we would run our systems on. We don't do that anymore, right? It's all cloud. You can't run AI unless it's on cloud. There's only 3 guys doing it. Oracle's trying to get in the game, IBM, but they're so far behind. So then the question is, if AI is what I think it is, and I think it's the real deal. It's like Warren said, if I gave you, back when he bought Coke, I gave you $10 billion, you couldn't unseat Coca-Cola. Do you know what the ante is now to get into the cloud computing game? Just to get to where you need to get to go get that business. Just tell somebody, oh, you don't need AWS or Azure or Google, I'll take care of it. It's probably, I don't know, 50 billion to get into 100 billion, maybe more. Who's got that ante? Right? Who can ante up that money? So I think those guys have got a lead, and I think it's the same thing with NVIDIA. I know ADM is behind them, and they're going to do the cheaper versions and stuff like that. They've got the H100, they're going to the B100. NVIDIA is going to generate $100 billion in free cash flow in the next 3 years. They can't buy anything. They tried to buy ARM, and the government said no. So what are you going to do with your $100 billion? Well, you can do the Apple. Apple bought back half its business in the last 10 years. Bought back the equivalent of United Healthcare on the way to becoming $1 trillion. I'm going to be a $3 trillion business, and by the way, I'm going to buy United Healthcare while I'm out. It's just amazing what that cash was. So they're going to go to the H100 to the B100 to the next generation. So you're in a poker game, and we're going to do chips for AI. What's the ante for the next chip? 50 billion? So did he go? I'm in. Intel goes, I don't got that much money. ADM, I don't have that much money. That's why you got these guys running around. I need $1 trillion to go do semiconductors. That's the game. So when you think about that, who takes the money? Who takes their business away? I can't, in my mind right now, I don't know who unseats that. Now, there'll be cheaper versions of AI chips for sure. You won't need all the high power. But the one thing that Jensen said on the call, and he's absolutely right, this AI thing is just now US-centric, and it's at the beginning stages. It's not even, Europe has no idea, they're way behind. They haven't got this fluid out at all. And we're right now at kindergarten level. If you think about the 4 phases of AI, the first phase was conversational, began at Dartmouth in 1956, a guy named John Murray, who invented the world artificial intelligence, which we wish he would not have invented that world. Marvin Minsky, the great economist, was there. Claude Shannon, the father of telecommunications. They all thought about, well, maybe these machines could actually do some things that are pretty incredible. Well, they thought about it for about 40 to 50 years because we never had the machines that could actually do the work. And it was only because of cloud and because of NVIDIA that you finally had a workhorse. AI is all about the ability of these powerful computers and chips and cloud computing to do massive amounts of computation on mountains and mountains of data to get you information that you didn't even know that you had, because no human could have ever done that. So we go from conversation to experimentation. And experimentation was largely what's been going on for the last couple of years until November of last year, and that was the watershed when ChatGPT came out. ChatGPT trained on 380, gotta get this right, 380 gigabytes. 1 gigabyte is $1 billion worth of data, or letter or space, whatever. So 380 billion bits of information. Where did they do that? Did it on the internet. They just turned it loose on the internet, so go to work. But you had to have a cloud to do it. You had to have that chip to do it. You couldn't have made that. Who has the most valuable asset? I'll give you this one. Who has the most valuable asset in AI today? And they have the worst public relations nightmare today. And what is YouTube? There's more data in YouTube than anything on this planet Earth. What they upload every day in video, text, photos, whatever. What AI is going to do to that, I don't know. And there's a reason why Zuckerberg spent $7 billion on the video chips last quarter, because he's probably second on the list that has the most information. Where AI is going to be hugely exploitable is on large data sets. Where I think the open AI's type stuff is, if they have a small data set, they're going to maximize out their opportunity set very quick. It's the guys that have these huge data sets that AI is going to strike gold. It's going to be, and we're at kindergarten, guys. It seems that we're going to make a lot of mistakes. There's going to be some bad press. But read that book, Prediction Machines. All this is about making predictions. Predictions lower risk, they add value, they increase profits, and that's why everybody has to get on board. So now we're in the experimentation phase, and we're starting the what's called the separation phase, which is some people use. How many people use AI in here? Okay, just one word of advice: check your footnotes. There were 3 lawyers in California that did a ChatGPT for one of their cases. The judge happened to recognize some of the references, some of the case studies, and said they're all wrong. They were fined $7,000. Poor lawyer, and they had a black mark on their CV, which means their career is over. So if you use ChatGPT, that's fine, but just check the footnotes, right? So we're right now in what's called separation. Some people are doing it, some people are not. But once they start reporting profits, like, how did you do this quarter? Well, you know, the AI did this, and our margins did this, and the profit did that. Then the last phase is mass adoption. Everybody's in. And this will be ubiquitous. Andrew Ng, NG, is that right? Ng, is that how you pronounce it? Ng? He's at Stanford, says AI is electricity. There'll be nothing more transformative in this country, or in this world, than what electricity was. It affected every person, every company, every business, every sector, every industry, every country around the world. That's AI. So now you got AI, you're going to give it up. That's like going to tell the company, oh, you know, that Microsoft 360 you got, it's kind of expensive. Why don't you give it back? It's going to give up Excel and Word and Outlook. No. Or how about Salesforce? Well, Salesforce is kind of interesting because there's some talk that could AI unseat Salesforce. I'm not sure about that. Michael had a great quote, James Bresson's New Goliath. These closed systems, software SAS systems, are very valuable. That's their moat. The question is, could AI unseat that? I'm not sure. But then a day will come and go, well, you got to get back your AI. You can't afford it. You can't afford to use it anymore. It's not the CEO in the world that's going to say, I'm giving back that AI. So I think this is pretty early. It's going to be volatile. There'll be givebacks. But, you know, if you're a growth investor, you're going to be paying attention to this. The bricks and shovels is the easy money on the front side. Then you're going to get to the software guys in the middle, and then the consultants will be on the end, and that's probably where it gets kind of rich and speculative. Yeah.
Thank you for your time. There are these great companies that you mentioned, they're all part of index. How can one beat then these great companies by active investing?
I didn't quite get that. Help me again.
So you mentioned all of these great companies which have tailwinds of AI,
Yeah.
and they have the money and the data
Yeah.
to succeed, and they're all part of index. How can an active manager think about
Well,
beating them?
Well, if you look at NVIDIA today, it's 4% of the S&P, right? Maybe 4%. I think Amazon's probably 2 or 3. You know, you add them all up. That's probably bigger than that, Mike. I've got that wrong. If you look at the S&P weighting of those guys, 4s and 5% bets, but we'll bet 8 and 10. So you have to, if you're going to make a bet on any stock and your benchmark is this, not only do you have a high active share that your portfolio is demonstrably different than what the market is, I would look at what the weight is of that stock. And NVIDIA is big, and Amazon is big, and all of them big, and say, well, what's the weight in the S&P? My bet will be different than theirs. I will overbet. Yeah. Yes.
Well, this kind of builds on her question, but with the massive flows to just passive investing in general, where do you think are the implications for value investors, stock pickers in general going into that?
Well, we wrote a paper. Remember, Mike, we wrote that sideways market piece for Bill in 08, 09. After that, and after the 08, 09 market, a lot of people thought the market was going to go sideways because of all the disruption in the financial system. It ended up being a great market from 2009 to 2010, but it launched me into writing a paper for Bill that I recently updated, which is who's afraid of a sideways market? Because everybody was saying sideways market, and there's some people that feel that maybe we're on the episode of a sideways market. The market's a little rich at 21 times. Economy is slowing. Earnings per share growth is maybe 6 to 10. Maybe go sideways. So I went back and looked, and one of the biggest sideways market was 75 to 82, right after the 73, 74 crash. And the Dow from the fall of 75 to August of 82 flatlined, no price change. The only return at the time was dividends, 5.6% average annual. At that time, dividends had very high yields. S&P did a little bit better. It did dividend yields plus 3% annual, but basically you went through a period of not making money for 7 years. But I remember, Buffett killed it. And, Ruane, Knapp, Lucent, all those guys were killing it. So these are buy and hold guys. So we went in and basically tore it apart. We looked at the S&P 500 through 75 to 82, 1-year returns, 3-year returns, and 5-year returns, rolling returns, and found out that in the 5-year rolling returns, there were about almost 18% of the S&P 500 on average on the rolling 5-year returns doubled. It's a 15% average annual return, plus or minus, which I would cut my finger and sign for a 15% average annual return right now, and no problem. And so, okay, well, how did that happen? So then we took the sectors of the market. And the sectors of the market, I might have had a piece. Yeah, here it is. This is talking about the evolution of markets and biology. They were the biggest sectors in 1975. The largest sector in the market was industrials, 15%. Materials was third at 15%. Utilities was the third largest sector of the market in 1975. Financials were fourth, consumer discretion. The smallest sectors were information technology and telecommunications in 1975. Almost flipped today, right? Then we said, of those sectors, who had the highest number of doubles? Energy had the highest number of doubles in the sector. Why? Any history students here? Oil price. Yom Kippur War. We sent arms to Israel. That pissed off the Arabs. They shut off the oil. Oil prices go this way. Second was industrials. They rode along with the price. Third was information technology. Had the highest number of doubles. Was the second smallest sector, but had the third largest number of doubles. Financials, upward sloping curve. Consumer discretionary was fifth, even though consumer discretionary was halfway the biggest sector. And there was Buffett. What did Buffett own in 75 to 82? Go back and look in the annual report. Newspapers, magazines, advertising companies, low capital intensive with huge pricing power. So then, as Michael taught me about Stephen Jay Gould, it really is, once again, explanation, descriptions. What did they tell you last year? That the only way that you could beat the market was to own the Magnificent Seven. If you didn't own the Magnificent Seven, you didn't beat the market. In fact, there were 134 companies. I wrote a fourth quarter commentary, said the Magnificent 141. Because in addition to the Magnificent Seven, there were 134 companies that outperformed the market. In our portfolio, we had 5 of the 7 Magnificent Seven, but we had 13 stocks that actually beat the market last year. So something more. So, Stephen Jay Gould says, don't get mesmerized by the averages. This is the difference between the trends in the system and the trends of the system. The S&P 500 flatlined for 7 years. What was going inside the system? And there's the answer. So if we are in for a sideways market or sub-normal returns in the market, you damn well want to be a stock picker. You damn well want to hire one. Because if you're long the index today, what is the yield on the S&P 500 today? Less than 2%. And it's not even going to keep up with inflation. You don't even get the 5 to 6% returns. So our thesis was, if it's a sideways market, you put on a barbell strategy. You want 5 and 6% dividend-paying stocks, just like 75 to 80, and then you want secular growth, things that actually can grow. What can grow right now? Thus far, of the $4.33 of the forward earnings that have grown this year, 87% of it is in the Magnificent Seven, ex Tesla, ex Apple. It's the AI. It's amazing. There would be no earnings growth in the market right now without these guys. So there's your sideways market. So secular growth, we can power through, that's going to earn you money. And dividend stocks. There's your barbell. What do you not want to own? The muddled middle. You don't want to own the S&P 500 that has a below average dividend yield. You don't want to buy low PE stocks that are crappy businesses that don't have big dividend yields. And you got to be careful about yesterday's growers. You know, things that used to grow that don't. You know, everybody jumping on Cisco and Intel and IBM. I don't know. You know, I'm not sure they got it compared to what the competition is. So you really kind of stay away from the stuff that's not going to gear. It's going to be tires in the sand. Get to the corners. High dividend yield will work, and you got to find the second. If you don't have AI in your portfolio in some form or fashion, and these things are not expensive. If someone tells me one more time this is $19.99, I'm going to kill myself. I mean, a freshman at Columbia can point out that the multiples today are nowhere near the multiples of $19.99. Right? How much time? Are we okay, Tom, on time?
I think we're good, and if you want.
We should stop.
Yeah, I mean, in the interest of your time, I know you have to.
Right, let me just leave you with this, and I'll stick around for just another, 15, 20 minutes. Multiples are not valuation, but they're market expectations. Here were the multiples of the four horsemen in 1999, when basically they were the darlings like Magnificent Seven. Dell was 57 times earnings, Intel was 31 times, Microsoft was 69 times earnings, Cisco was 101 times earnings. On the cover of Barron's in October 1999, they recommended owning that Cisco, you can look it up, at 100 times earnings. Dell went up 7,800%, Cisco went up 2,600%, Intel went up 1,000%, Microsoft went up 1,400%. Well, then I looked at how, that's 5 years of our Magnificent Sevens. Other than NVIDIA, everything's up 100%, 170%, 160%, 290%, nothing like the total returns back then. The multiples are half of what they were back then. We have only gone up a fraction of what we had gone up back in 1999. This is still very, very early stages. Thank you for your time. I'll stick around 15, 20 minutes if anybody wants to go one-on-one. I really appreciate it. Thank you very much. Thank you very much. I appreciate that. Help me with your.
There's only anything to get up on 2000.
There you go.
What you can do on time
Team one, yeah, team one.